Hi everybody. In this series of instructor video lectures, we'll look at some common forms of compensation in which the amount of compensation employees receive is tied to the market price of the company's stock. We will see that these share-based compensation plans often affects the way we calculate earnings per share. In preparation for the study of Chapter 19, you might want to take a few minutes to review the earnings per share calculations in Chapter 4 of your textbook. Employee compensation plans frequently include share-based awards. These awards are forms of payment whose value is dependent on the value of the company's stock. These may be outright awards of shares of stock, it may be stock options, or cash payments tied to the market price of the shares. Sometimes only key executives participate in stock benefit plan. Typically, an executive compensation plan is tied to the performance in a strategy that uses compensation to motivate its recipients. Actual compensation depends on the market value of the shares of stock. Although variations of share-based compensation plans are seemingly endless, each of the plans share common goals. Whether the plan is a stock award plan, a stock option plan, a stock appreciation rights plan, SARs, or one of several similar plans, the goals are to provide compensation to designated employees while sometimes providing those employees with some sort of performance incentive. Our goals in accounting for each of these plans are, first, to determine the fair value of the compensation, and second, to expense that compensation over the periods in which participants perform services. That is so important. Let me say it again. Our goals in accounting for each of these plans are 1. Determine the fair value of the compensation, and 2. Expense that compensation over periods in which participants perform services. Executive compensation sometimes includes a grant of shares of stock or the right to receive shares. Usually, such shares are restricted in such a way as to provide some incentive to the recipient. Typically, restricted stock award plans are tied to continued employment. The two primary types of restricted stock plans are A. Restricted stock awards, and B. Restricted stock units. In a restricted stock award, shares actually are awarded in the name of the employees, although the company might retain physical possession of the shares. The employee has all rights of a shareholder, subject to certain restrictions or forfeiture. Ordinarily, shares are subject to forfeiture by the employee if employment is terminated within some specified number of years from the date of grant. The employee is usually not free to sell the shares during the restriction period, and a statement to that effect is often inscribed on the stock certificates. These restrictions give the employee incentive to remain with the company until rights to the shares vest. The compensation associated with share of restricted stock is the market price at the date of grant of an unrestricted share of the same stock. This amount is accrued as compensation expense with a credit to paid-in capital restricted stock over the service period for which participants receive the shares, usually from the date of grant to when the restrictions are lifted, which is the vesting date. Once the shares vest and the restrictions are lifted, paid-in capital - restricted stock is replaced by common stock and paid-in capital in excess of par. Any market price changes that might occur after that do not affect total compensation. An increasingly popular variation of restricted stock awards is restricted stock units, or RSUs. In fact, RSUs have become a much more popular form of compensation than their restricted stock award cousins. A restricted stock unit is the right to receive a specified number of shares of stock. It could be a performance bonus, it could be a signing bonus, or regular compensation. The employee does not receive the stock right away. Instead, the shares are distributed as the recipient of the RSUs satisfies the vesting requirement. So, like restricted stock awards, the recipient benefits by the value of the shares at the end of the vesting period. Unlike restricted stock awards, however, the shares are not issued at the time of the grant. Delaying the increase in outstanding shares is more acceptable to other shareholders. Terms of RSUs vary. Sometimes the recipient is given the cash equivalent of the number of shares used to value the RSUs, or the terms might stipulate that either the recipient or the company is allowed to choose whether to settle in stock or cash. Well, that's all for this video. In the next video, we'll work through an illustration of accounting for the grant of restricted stock units. See you next time.